All right. Well, hello, everybody. Well, all right, let's start, folks. It's been a long time since I've been here, been away, been traveling, been busy with other things, but FX Trade has always been like home. It's good to be back over here. Good to see some familiar faces. Jayanti, good to see you. Boyke, how have you been? FX Boyke, it has been a very, very long time. Hi, Lori. Let me start off by saying that we will be having this seminar or this webinar every Thursday at the same time, and I want to start off from the basics. So what we are going to do, what I am going to do is share some very basic stuff. I'm sure most of you are pretty experienced traders here, but in spite of that, just bear with me if I give you some information which may seem very, very basic, but I believe it's quite important. So every Thursday, I'll be going over one point or the other about trading, leading to some technical analysis, procedures of trading, money management, psychology, which I believe is very, very important for traders, new as well as experienced. It's come from my experience, very frankly. I know what I need to succeed in the market today, and I just want to share my experiences. Now, today's presentation is, as a matter of fact, is just the same presentation which I did last couple of weeks back when I was in London for the World Money Show. We had the World Money Show in London, and I did a presentation over there. I wanted to repeat that. So if any of you were present during that presentation, it may be a repeat of it. But once again, I would really like to repeat it. It would be quite good. All right, so please bear with me if I sound a little boring in the beginning. I promise you the sessions will get interesting as in every time. I'm just building up things right from the basics. All right, let's come down to the facts. I don't think I need to go through these particular facts. That what is the forex market? Everybody's aware of the forex market. But one thing is, let's just go over something about most of the traders are unaware of, or they do not really concentrate on these factors. That most of the trading done in forex is for speculative purposes. Right? Could you just confirm one thing, because I have the chat box on over here. Is it coming in between, or are we okay? Can you see the screen clearly? I just hope it's not disturbing. It's not disturbing the screen. Yeah, okay, fine. No, good. Because I just need to keep the chat box open in case there are any comments. All right, let me go ahead. All right. The statistics say that almost 80% of the trading in forex is done for speculative purpose, which means that it's only 20% of the trading which is done by genuine companies who are exchanging currencies, banks who are buying and selling currencies for their clients. So if 80% of the trading is non-deliverable, as they say, which is carried forward or closed subsequently, what is the basis for this speculative trading? Is it fundamental analysis? Is this technical analysis? Could be both, because a lot of retail traders do trade on fundamental analysis also. But from my experience, I can say, and compared to the other markets, that forex is one of the few markets where technical analysis is considered to be a prime factor. Now, if technical analysis is considered to be the prime factor, then most of the traders tend to trade on technical analysis. Let's get down to this most important fact, is that 85% of the traders lose money. Now, if 85% of the traders are losing money, what is the reason for it? Let's just get over it. I believe in something what I call as the 3 M's. I'm sure quite a lot of you are familiar with the 3 M's, because this is what I preach all the time. This is what I practice. If I distribute the 3 M's, the money, mind, and method, the money management, if I distribute it on a scale of 1:10, would constitute about 5 parts. The mind, which is your discipline and the patience, constitutes about 3 parts. Now, the method that we are talking about, the technical analysis, which I just mentioned, or fundamental analysis, you may put it down, anything, would constitute only 2 parts. Now, this is a problem which I have seen even as of today, that most traders think that technical analysis is the trading plan by itself. And I really think that it's really not the trader's fault. Because today, if you look on the internet, there are millions of sites available for forex trading. You purchase a book, you purchase a course. Everybody talks about technical indicators. They talk about chart patterns. It's very rare that you will come across some course or some book or a technical system which will talk about money and mind, which is very, very important. Now, if we saw the distribution over there, where your technical analysis is the least important part of the trading, so is this the reason why most of the traders lose money? Because most new traders, when they come in, they're really not aware of what works and what does not work. And they'll buy a book, they'll look at the indicators, buy, sell on crossover of stochastic lines, MACD lines, moving averages. And isn't it a fact that I have seen today, I have been conducting personal mentorship courses for a lot of traders. I have traders come to me with blown up accounts, and believe me, I have turned around the accounts. And this is a basic thing that I have seen why most traders lose money, is that it's technical analysis, that's what they concentrate upon. Once again, I mentioned that it is not the trader's fault, because you start your trade analysis from the charts. Obviously, in this you look at indicators, which of course are lagging. So you look at indicators, you do not look at money management at all. You do not look at your mind factor, the discipline and the patience to have a trade plan and follow it. Now, is it surprising that these traders lose money? It's really not surprising. That one of the main reasons, there's a reason why I actually wanted to start off with this, because it is the basic thing. Let's just go over something very, very simple. And before we come down to this, let me put this right over here itself. When you are trading, let's just put down to this. When you're trading, you're buying and selling a currency, or maybe equities, commodities, derivatives, anything. In actual, what you are doing is you are trading other traders, for the simple reason that when you're buying something, there has to be somebody on the other side who has to sell it to you. Similarly, when you're selling, there has to be somebody who has to buy it to you. In fact, what you're doing is you are trading other traders. You have to learn to think like the professional trader in the market, and the professional trader respects money management and the mind factor, which a new trader, the amateur trader, does not even bother to look at. And believe me, this is one of the main reasons why I have seen traders fail, because they do not know what to concentrate upon. What I want to say, or what I want to put down over here from my experiences, just give you some path that you may be a good trader, you may be having your own technical systems, you may be good, you may have succeeded, your account may be down, but if you tend to concentrate more on your money management and on the mind factor, we'll just come down to the mind factor in a little bit, believe me, you will see the difference in your trading. I have seen it, it works. Right? Let's put some very, very common pitfalls which new traders come up with. First of all, of course, is unrealistic expectations, which again is, you come across advertisements today saying brokers are advertising that trade, sit at home, work in your pajamas, work 24 hours, 24-hour market, work whenever you want to, make millions of dollars. And believe me, I've come across brokers who say that you open an account with $500 and make millions of dollars. So obviously everybody is very enamored by this whole concept of sitting at home and making money. And you open an account with $1,000, you want to double your account in 1 month, and you want to buy a Ferrari at the end of 1 year. And this is really unrealistic expectations. Let's just put down one very simple fact. When you talk about trading with, or you talk about institutes who are trading, the hedge funds, the best of hedge funds, managed funds if you can call them, what are the returns that they are offering? The tops would be about 10 to 12% per annum per year, right? Maybe 14%, maybe 15% to stretch it. Nobody even goes that much. So we are talking about a max of 1% a month. Now we are talking about these hedge funds who have got deep pockets. They've got the best of resources available to them. They've got the best of traders there. They've got the best of systems. If they can manage about 1% a month, which is supposed to be good, why does a new trader think that he can make 100% in 1 month? Something to talk about, something to think about, which again a lot of new traders don't really think about. Second fact, of course, is undercapitalization. Believe me, if there was something, if somebody told me that if you want to bring in some kind of a rule for trading, what is one thing which you would implement for forex trading very specifically, where high leverage is available freely? I would say you should not allow any new trader to open an account with less than $3,000. For me, trading a mini account, minimum is $3,000. If you open an account with less than $3,000, believe me, you are just throwing away the money, until and unless you're very lucky or you're an exceptionally good trader, which maybe some of you are. I'm not saying that. But money management depends on capital. Undercapitalization in forex, I would say, is a crime. And if you think that you can open an account with $500 and make money, well, you are in for a serious reality check over here. And then ignoring the rules of money management, which we'll just go over that. Depending on indicators, of course, all indicators are lagging. Every indicator has got its own specific purpose, has got its own specific characteristic which you must trade on. And trading with indicators, depending on indicators, yes, but trading with indicators, there is a difference in that. Let's go over this. Now, this is some of the charts that I come across for new traders. Right? You have an RSI, you have a MACD, you have a slow stochastic, you have 4 different moving averages. In all of this, where is your price? You can hardly see your price action. You just cannot see your price action. Now, simple fact is, and believe me, I have seen traders like this who have 4 indicators. Now, all the 3 indicators in the lower windows over here are oscillators. Now, any indicator which is banded between a value of 0 to 100 is known as an oscillator. So your RSI, your MACD, your stochastic, your CCI, your momentum indicators, they are all oscillators. Every oscillator has almost the same characteristics. So you have 3 indicators giving you almost the same interpretation, if you can call it. Why would you want to use 3 indicators to give you that? You're only confusing things. But a lot of traders like it. Because as I said, they think that indicators is the key to success, and they will plot so many indicators. Let me just show you my charts. Believe me, if I can switch applications over here, I'll just show you what my charts are, and you'll see that I hardly use any indicators. There you go. Of course, this is one harmonic pattern on the Euro USD which we traded recently, and it's been on a rise since then. But if you look at this, it's price action and maybe Fibonacci's. I do not use indicators. I would rather concentrate on price action. It is price which is giving you the leading factor. All indicators are lagging. Now, if you look at any indicator, if you look at the calculation of some indicator, oops, what happened? Should I close it? Just give me a moment. Stop sharing this one. Just give me a moment, please. I'm a little confused about... Okay, there we are back again. Sorry about that. Right, so if you look at the calculation of an indicator, just do a Google search on, let's say, the RSI and look at the calculation. You'll see that price is an important factor. It depends on price. So obviously price turns first, which makes the indicator turn. So why does a new trader, any trader for that matter, think that an indicator is going to give you something very different or a leading factor? It does not. Let me take an example of trading with indicators, which was just a situation which we experienced in the live trading room just about a couple of months back, and I thought it was well worth sharing this application. Just give me one moment, please. I think are we all okay still? Yeah, everything fine? Just want to do a quick check. Okay, all right. All right, John, I'll do that. I just wanted to check the same thing, that if everything is okay. Right, so what I'm going to do is I'm going to do the layout of this one, put it down to no, sorry about that. I'm a little confused over here. I can't get this presentation views. Oops, let me close this. Okay, there you go. I'm sorry about that. Harmonic indicator. I don't use the harmonic indicator. I plot them manually for that matter, so I don't depend on common indicators. I would rather do them manually. I don't use any indicators. All right. Anyway, let's come down to this. This was an actual situation, as I said, based on indicators. You had price in a downtrend over here. Let me see if I can get the annotation tools. Just give me a moment. This is my first session here, so I'm a little unfamiliar with the annotation tools. So, okay, all right. So you had price moving down and consolidating. You had it in a nice double bottom, triple bottom, formed a small good base, started moving up, and went kind of oversold, overbought over here. And this was actually a situation. I'm sorry, I need to clear all annotations. Sorry about that. And what you did have was price moving up, and you had this, if you look at the circle down over here, the indicator, the stochastic moving up and going down. So it was a good indication of a sell. So one of our traders said, okay, this looks nice and overbought over here, so let's sell. Your indicator is completely overbought, right? And that's what the books tell you. That's what the theory tells you. And what happens is price gave some small retracement and boom, went up and got stopped out. All fine. All right. I'm sorry, Berkey, you have some problems. Okay. So we had this stopped out and you're waiting there for price. Oh, okay. Thanks. And then price makes a nice divergence once again. Right click and fit in viewer. Okay, let me try that, John. Where I don't have layout. Nope. No, I think this one's good enough. All right, John, now you're confusing me over here. All right, to the peeps who are watching, okay, let me get back to what I'm doing over here. You figure out, you guys figure out over there. I'm getting confused in the process here. All right, so we had one losing trade and price went up, and now it looked like a pretty decent divergence. You had price making higher highs, and you have the indicator making lower highs. So, all right, so let's sell over here. Right, so what happens is that you sell and price comes down. Okay, you've made some good amount of profit. Price moves down. Price starts getting or starts basing down over there, finding some kind of support. You have 1, 2, 3 bars not being able to close below a particular level, so it's support. And you have something telling you that, okay, let's take some profits. But what happens is that you say that I have taken a loss earlier, I want to recover my loss as well as make some money over here. Now since it's gone so good, let me move it down, get it down a little more. I'm sure it will go down to the previous bottoms that we have seen over here. Previous bottoms, it will make another triple bottom and it should move down. And boom, once again price moves up and you get stopped out once again. Now this is indicator trading. Believe me, there's no price action involved over here. There's nothing else involved, just looking at indicators, selling basically on indicators. The reason why I went over this is, let me go over this particular slide. This green band, as you can see, could you see the green band in the previous charts that I have put across? This green band was on a larger term time frame, was a very nice zone of support and resistance. Now believe me, it's simple price action. Oh, Chris, it happens to me also. See, there's one thing which I will say, that losses are a part of trading. Believe me, the win-loss ratio, that when we talk about a win-loss ratio out of every 10 trades, I would say that if you get 6 trades correct, or it means 7 trades correct out of every 10, you are a good trader. That is the kind of trading, or that is the kind of losses that you can expect. But you can minimize those losses or improve on your win-loss ratio when you use the right methods, you use the right techniques. Simple fact is that if I'm trading on a smaller term time frame and looking at this particular example, if I see on a longer term time frame that there is a strong zone of support resistance. Now these zones, this is something which I go over in my trading room very often, is that these zones are like magnets. Anytime you come across a zone like this one, which was support turned into resistance, and you have price moving up towards it, it is like a magnet. It will attract price towards it and price will move towards it. So if I'm trading on a smaller term time frame and I know that price is still going to go up there, why on earth would I want to short it? But then this is exactly what new traders do. They rely solely on indicators. This is the main reason for putting across this particular example, if you can say that they rely only on indicators. You don't look at the overall picture, you don't look at the larger picture, you don't look at price action, and within this you can forget about money management and the mind factor. Now, is it surprising that traders lose money? If you do it correctly, believe me, it is not difficult to make a living out of forex. There are people who have done it, I have done it, and it is not difficult. It's the only question of doing things correctly. That's about it. Right? So all indicators are lagging and one must never use them to determine the trading parameters. Now this is a very, very important part. If you are going to determine your trading parameters, which simply says that you're going to enter your trades based on an indicator, let's say that, okay, if the stochastic lines cross over, I'm going to enter the trade and I'm going to exit the trade, that the moving averages, once they start moving down and the moving average crosses the other moving average, then I'll exit the trade. And you place your stops. I'm going to place my stop above this moving average or maybe beyond the scope of this Bollinger Bands, which actually maybe it works. You are headed for trouble. Your trading parameters have to be on price action. It has to be on simple zones of support resistance, maybe Fibonacci levels, pivot levels, whatever you're comfortable with price action. Indicators are lagging. Now, if you're going to enter on a break of, or let's say a crossover of a line, you will be entering a trade where more than half of the trade is already over and done with. It's finished. And believe me, then you are the sucker who gets into the trade at the end. And this is what the professionals look like. Hasn't it happened to you so many times that you enter a trade, you're looking at a trade, right? Everything is going hunky-dory. You're waiting to get into a trade. Price starts moving up, retraces down, you're patient and you wait. I said, okay, it looks good. And then you enter a trade. The minute you enter the trade, price turns. I get this complaint a lot of times. Believe me, a lot of times, that the market gods are against me. They know exactly when I am going to enter the trade. Till the time I'm not there, everything's going fine. The minute I enter the trade, price has to turn. There's nothing wrong with the market gods. The market gods respect technical analysis, if you can call it that. You are the one who's at fault. The trader, I would say. I'm not putting the onus on somebody in particular. You are not looking at the larger picture. You're using indicators. You're doing all the wrong things. You're not following money management. How do you expect to survive in this market? You cannot. Believe me, this is what I call as a shark pit. You are entering shark-infested waters, and if you're not prepared, you will be eaten alive with no mercy. Right? Okay, expectations. Expect a reasonable return on your capital. As I said, don't expect to make 100% in a month. You cannot. Nobody can do it unless you are exceptionally lucky. You will have some months of winning trades. You will have some months of losing months. There are some times when your capital goes down. And treat it like a business. You have to put in the required efforts and the required capital. It's not going to generate profits from day one. Now, if you compare it to a normal, let's call it a brick and mortar business, would you expect to put in, you want to start off a business in real life business, would you expect to put in just $500 and trade about 2 hours a day and expect to make double your money? You can't. You have to put in the time and efforts to understand the business, to work at it. It's similar to this. The problem is that most new traders do not think like that. They think it's a get-rich-quick scheme, which is what is advertised, very frankly. So treat it like a business. I mean, you have to put in the efforts. For me, believe me, since the time you start off your trading, for me, I'm saying that 6 months to 1 year is your break-in period. If you survive 6 months to 1 year and you understand the market, you are in a business where you will make money for the rest of your life. Most of the traders don't survive the first 3 months. The statistics say that it's not going to generate profits from day one. Losing trades are a part of trading. Do not expect to get all trades correct. As I was saying, we are not astrologers. This is another thing which I have seen in new traders, that it becomes a kind of an ego problem. That you tend to think that you want to get all your trades correct, and if you don't, then you're not a good trader. Believe me, that's not the case. Best of the traders have got the share of losing trades, and which is something which you should expect. It's not easy. What happens is, in the real world, when you are working somewhere, when you are not supposed to make mistakes, that's what you've been told, right? But in trading, I would say that you are expected to make mistakes, and you have to gear up your trading plan to overcome those mistakes. That's the best way to go about it. Paul, mainly I hold positions for a longer term time frame. Day trading, I don't really day trade too much. I rather trade on longer term time frames. Like the chart which I just showed you was a harmonic pattern on the Euro USD on the daily time frame. I preferably trade on the 4 hour and above, maybe 1 hour at the minimum. I generally don't go below that. Alright, so it's a business of, and finally it's a business of probabilities. As I was saying, that you cannot really guarantee the outcome of your trade. You just cannot. Right, now money management. Let's come down to the crux, or the most important part of this presentation. Money management. Let me just put down 2 rules for money management. Oh, is that right? Okay, I have just put up my audio levels to the maximum. Are we okay? Ahmed, if it's bad for you, would you just re-log into the room? This happens sometimes. Alright, right, so money management, the most important. Let me put down just 2 rules for money management. Now believe me folks, if you follow just these 2 rules of money management, you will see the difference in your trading. I can guarantee you, I won't say guarantee is a very strong word, I can assure you that if you follow these 2 rules, you will definitely see an improvement. Now, I'm sure a lot of you traders are definitely following these rules here, but at the same time, if you're not, then this is something, right? 1, never risk more than 2% of your capital at any given time. Maintain a minimum risk to reward ratio of 1:2. Now this is easier said than done. I get a lot of questions about why must you risk only 2%? You have so much of capital available with you. If you're going to trade with such a small amount, your profits will be small, which brings me back to the earlier point of undercapitalization. Obviously, if you're going to start an account with $500 and 2% of $500 is $10, you can't take a trade with $10. I mean, you can't put a stop loss of $10. You'll get stopped out in no time. So it doesn't make sense, which again is interrelated to your capital requirements. Is if you need to make a decent amount of profit in a month, when you are going to be paid for your time and efforts. Obviously you need to be paid for your time and efforts, and if you are not going to risk a large part of your capital, isn't it a fact that you must have a larger capital with you? And believe me, larger capital, your money management principles work best on higher capitals. Plus the simple fact is, live to fight another day. You will have your share of trades. You may come across a streak where you have 5, maybe even 10 trades, losing trades in a row. It happens. This is part of trading. You must have sufficient capital to sustain those drawdowns and still remain in the game. That's what trading is all about. Let's go over the basics or the mathematics of money management. Always measure your performance over a basket of 10 trades. Never measure your performance based on a single trade, that I have lost today or I have won today and I'm a good trader and I'm a bad trader. Over a basket of 10 trades is logical, it's a good number. Assume a win-loss ratio of 60%, which says that you will get 6 correct trades out of 10. Now if you maintain your risk to reward ratios of 1:2, that means if your, let's start off from here, if your required stop loss is 25 pips, which means that your expected profit must be at least 50 pips. So if you do the mathematics, 6 winning trades at 50 pips, you are 300 pips, 4 losing trades at 25 pips, minus 100, your net effect is plus 200 pips. Right? Simple mathematics. Now, let's just get into some very basic stuff. When I say we talk about smaller term time frame, we had a question on what time frames is it. Let's say that I'm trading on a 5-minute time frame. I want to explain to you why I find the smaller term time frames disadvantages. It's not that you don't trade on that. You do. I do go down to smaller term time frames to fine tune my trade entries or look at the price action correctly. But if you base your risk to reward ratio on smaller term time frames, it doesn't work. Let's say I'm trading on a 5-minute time frame. Right? What is the minimum stop loss that one would be required to be kept in a trade? Right? I assume everybody's going with a stop loss. If somebody's going without a stop loss, I would seriously suggest have a relook at it. There are some traders I know who do it. For me, it's the best safety net. It's just a personal opinion, but as I said, I'm sharing my experience over here. Now, if you look at, would you give price some breathing space, let's say about 10 to 12 points, to give it some breathing space? If you place your stops within that, you'll get stopped out for no rhyme or reason, which defeats the very purpose of putting up your stops. Then you take into account spreads. Whatever is the spread your broker is giving you. You take into account bad fills. Now, when your broker tells you that you have a spread of 2 on the euro, most of the times, believe me, in real accounts, it really doesn't work that way. You will get filled in at maybe 3 to 4 pips. Take into account some bad fills sometimes, which does happen. These are practical problems. So I would say minimum of 20 points. If you keep a stop of 20 points, that means your expected profit, if your money management has to be applied, must be at least 40 pips. Do you expect to make 40 pips on a 5-minute time frames? It's not possible. On a 5-minute time frame, at the most you may get a move of 15 to 20 pips. And if you're looking at 20 pips on a 5-minute time frame, that means your stop loss should be about 10 points. If you place a stop loss within 10 points, I can guarantee you that you will get stopped out for no rhyme or reason, which defeats, as I said, that defeats the very purpose of placing a stop. So what traders often do, this is where your money management goes for a complete toss, is you're trading on a smaller term time frame, you're aiming for 10 to 15 pips, and you're keeping a stop loss of the same 10 to 15 pips. So what is your risk to reward ratio? It's 1:1, maybe even lesser than 1:1. Now do the same mathematics on smaller term time frames with a win loss of 60% and see what is your return. If at the end of 10 trades your account is in minus, then why are you trading? It's a simple fact that at the end of 10 trades, whether I take 10 trades in a day, whether I take 10 trades in 10 days, if at the end of 10 trades my account has not grown, I am wasting my time. Isn't it a fact? I am not here to gamble. I'm not here to hope for price to move in my direction or hope for my account to grow. I'm here to see that my account grows. Simple facts of money management, folks. Very, very important. But as I said, most traders just do not think about it or are not aware of these simple facts. Trade plan. Very important. Now, this is where the mind factor comes in. You must have a trade plan which must have every aspect of the trade covered before you enter the trade. Very important. So your trade plan must have your entry, where you're going to enter the trade, what is your stop loss, what is your expected profit. Now, you may get a profit, you may not get a profit. Your rules of money management has to be defined, your trade management has to be defined. All of this has to be defined before you enter the trade. Which brings me to the mind factor. Right now, if I have a trade plan, let's come to this. Let's say I'm trading, I just showed you a harmonic pattern. I'm trading a harmonic pattern. I see a setup on the harmonic pattern and I have a trade plan saying that only if I see a harmonic pattern am I going to trade. If I do not see a harmonic pattern, I will not enter a trade. Whether I'm trading on a 5-minute, whether I'm trading on a daily, whether I'm trading on a 4-hour, if I do not see that, I do not enter the trade. Let price go 500 pips without me, I will not enter a trade. If there is no setup, I do not trade. Can you do it? It's not easy. It's easier said than done. Believe me, even for me, it's easier said than done. But this is what separates the professionals from the amateurs. You have a trade plan saying that, okay, I'm going to be trading this one particular setup, or maybe 2 setups for that matter, if you're experienced enough. And until and unless I do not get this set up, I will not take a trade today, tomorrow. I will not take a trade for the entire week. If you can do that, believe me, what happens is it increases the probability of your success. What you're doing is you are eliminating more than half of your unsure trades. And whatever trades you're taking have got a higher probability of success. And as traders, don't you think that we would rather take one trade which has got a higher probability of success than take 5 trades which have got lower probabilities of success? If you're going to just trade for the sake of trading because price is moving, then you're gambling, you are not trading. That is very important. And once then coming down to the patience and the discipline, so your patience, your mind factor is wait for your setup. Once your setup is identified, then the discipline comes in. I'm going to apply my trade plan. This is where I'm going to enter. This is my stop. This is my expected profit, which gives me my risk to reward ratio. If it doesn't fit within my risk to reward ratio, I do not trade. If it fits into it, I have everything written down. If price is going to go my way, this is how I'm going to manage my trades. If price starts going against me, which it does, then this is where I will plan to get out. I call it the pain level. I keep a level even before the stop loss level as a certain pain level. That price crosses that and I know that, okay, something's gone wrong. The momentum is not really picked up. Get out of the trade even before it goes to your stop. As a trader, my first priority is to preserve my capital. If I can reduce my risk in any way possible, it automatically increases my profits. It's just as simple as that. Right? So, patience. I will not trade till I see the trade. I will not trade for an entire week. If price is going somewhere without me, I will not trade because it does not conform to my plan. So applying the 3 M's in the trade plan, my entry, stop, exit enable me to calculate the risk to reward ratio. If it does not fit into it, I do not trade. If it fits into it, I decide on the position sizing. Position sizing is simply the number of lots that I would trade on this trade, the amount of capital that I will expose on this trade. There are certain formulas for position sizing which we will cover in the subsequent webinars over here. If it doesn't fit into it, I just, again, as I said, I want you to put down, teach, and just walk the talk also. And let me end up with one saying which is one of my favorites actually, is that trading requires the patience of a saint and the discipline of a soldier. We have one of my, she's quite there as a matter of fact. So anyway, it is a good solution, Ahmed, that you concentrate on a couple of currency pairs so you know their behavior very well. It helps a lot, definitely helps a lot. Yes, Susanna, and perseverance, absolutely. Well, folks, I think we just exceeded the time a little bit, but due to the technical issues, not a problem. I will see you next Thursday. If we have time, over 2 minutes, if you have any questions, feel free. I'm here for some time. We can just stretch on for another 5 minutes. I'll see you folks next Thursday with another trading procedure. Susanna, I'll let you know about that. Our trading room right now is kind of on hold due to a lot of things. So as soon as it starts, I'll let you know. Alright folks, it was a pleasure being over here. It's always nice to come back to FX Street and see all of you folks. I enjoy interacting with all you traders over here. It's real good. Thank you very much for attending. I'll see you folks next week. Have a nice trading week. Have a great weekend. And of course, if anybody has got any questions, feel free. This is my email. It's there on the slide, of course, but here I'll just put it down over here. If you have any questions, feel free to send me a mail. I'm always available. There you go. Yes, next Thursday, same time. Alright folks, so I'll see you folks next Thursday. Thank you very much.